we are going to look at what happened with respect to three important commodities: gold, silver, and crude oil, and also going to look at what probably can happen in 2023. What are the developments that are likely to impact these markets and how these are likely to move. Now, when we put in the performance, you yourself can compare how the commodities have performed with the equity indices, and then you can take a call as far as the investment is concerned. Now, we are going to talk only in terms of first in gold in rupee terms, then silver in rupee terms, crude oils also in rupee terms. Before that, let me take a recap of the Nifty performance, because this is going to be used for comparison. Because a lot of you may be wishing to know that what about gold investment, and gold investment, how it should be, how the investment should take place. Because one is that you can buy as an ornament, you can buy as a gold bar, you can also buy gold bonds. So which one of this is going to be profitable? Now, Nifty, we saw the 1 year performance is around 4%. I'm not going to the decimal places. 2 year, all these things are compounded, what we call as the CAGR, compounded annual growth rate, CAGR, and this is what we are going to look at in commodities also. 2 years performance in index Nifty is 13.6%. 3 years is 14%. 5 years is now as 12%, and 10 years also we look at it. 10 years is also approximately 12%, is 11.8%, so 12%. So long term, the equity markets steadying itself around the 12 to 14% annualized return. So this means normally the equity markets EBITDA growth, that's what we are saying, that EBITDA growth is approximately in right now going at a CAGR of something like 12 to 14%. That is what is reflected, because if you look at the PE in Indian markets 5 years, 10 years back and all, it was around 15, 16, 17, 18 PE. Right now it's around 20, 21. So not much of an expansion of PE, or the PE expansion will have very less impact on a bigger time horizon. So in a 3 year it will have less. 5 years it may be a little more pronounced. Only in the 1 to 3 years it can become more, particularly the 1-2 years is more affected by a possibility of a PE expansion on the return. That is, now we are trading at a PE of something like 22 and all. Suppose if it suddenly the market becomes bullish, it can go to 25 or 26, which can look at a very big return in the shorter term. But in the longer term, if you look at it, the average of PE in the longer term of 10 years is now approximately 20-21, and that is where the present PE is. So that means market would have just grown at this particular EBITDA growth would have been just like this, of around 11 to 12% over a period of 10 years. In the case of 3 years, 5 years and 2 years, there has been in the 5 years PE average is around 24-25, and we have had a fall back around 21-22 now PE, which means there has been a 20% drop, but over a period of 5 years, which means 4%. So that means EBITDA in the last 5 years should be growing something like 16%, 15 to 16%. So here in the 10-year period, probably we are looking at something an EBITDA growth of 12%, and in the last 5 years, I think the EBITDA growth is around 15 to 16%. So that means this gives us a confidence that if the EPA, if Indian companies are going to be more profitable, and the EBITDA growth is going to be good, and we are having at a decent PE ratio of 21, 20, 22, and let us say after today's correction, it may just fall to around 20-21, which is a very good sign, because we have already illustrated that this market probably at around 17,240, 250 levels, or even closer to 16,600 can become quite attractive for investment based on a PE of 20 and with an estimated EPS of 830. We are looking something like a 16,600 or so could be a very good place to go for investment in the Nifty ETFs. So now what we are going to do is that we are going to compare this return of Nifty with what has happened in gold. Then we will know probably how these two asset markets have performed and how we should invest either in Nifty or in gold, and if you decide to invest in gold, which is the right avenue for that. So now I'm not going to the first, we will look at the chart also in gold and then come back to we'll look at gold futures, MCX futures if it is there. So we'll look at okay, so not many years it's showing, so we will look at it's giving a return. We are not able to scale back to 2012, but it's only from 2015. So it looks as if in the last 6-7 years there has been quite a steep increase as far as gold is concerned. But let's look at the monthly chart. So see, the prices year is coming only from 2016. Nevertheless, we have taken the data and our analysis I'll give you. Gold in Indian rupees in 1 year, the return is approximately 8% per annum. Compared to 2021, 2022 return is 8%. Nifty is around 4%. So here, gold is an outperformer, right? So in 2 years turn, we have already mentioned that Nifty has 13.6%. Gold return is only 4% per annum. This is a CAGR return. On a 2-year basis, gold has not performed. On a 3-year scale, gold 14.25 and this is 14. So both are almost same. So on a 5-year basis, this is 12.25 and this is 12. Approximately same, because these are all probably there's a chance that you'll have some dividends also coming, and so these are what we can do is that probably we look at the gold interest rates and bonds and also look at the potential dividends there. Now on a 10-year basis, now let's look at the 10-year basis. On 10-year basis, gold has given only 5.5% CAGR versus 11.8% in Nifty. So in this place, Nifty has done extremely well. So what the difference between gold and the Nifty is, see, one similarity is there. All of them are positive asset markets. All of them are positive asset markets. The reason I'm saying this is that when we look at another item like silver, okay, we'll know that there is a negative return itself over a longer period of time, which is good, which is not good. So you have to avoid silver as far as long-term investment is concerned. But both gold and Nifty have really given a good positive return over a period of time. But on a longer term of 10-year basis, gold has given only 5.5% CAGR, whereas Nifty has been generally good, 13.6, 14, 12, 11.8. So it is a little more stable except for this 1 year. Probably that means probably next year or so, we 1 or 2 years down, we should see a good return coming from this base. So 2 years, 3 years should start doing well because of this 1% 1 year lower return. So now if we look at this, we should be asking us as to, is gold really a great investment as far as the long-term investment is concerned? Now, if you look at the gold in rupees, we have already highlighted that gold in rupees is a byproduct of gold versus gold and dollar rupee. Gold in rupees terms is a combination of gold in dollars plus the dollar rupee factor. So both of them combine to give the rupee prices. When we say the 10-year return in gold is 5.5%, you will be surprised to know that this 5.5% has been contributed mainly by dollar rupee to the extent of 5%. That means gold in dollar terms has not given any proper return. gold in dollar returns over a period of 10 years has not provided any return. Now we will look at the chart and explain to you, but in 2012 and 2012, what happened as far as gold is concerned in dollar terms. Now let's look at this chart. This is a yearly chart. 2011. So this is 2011. 2012 end. It is 1676. 2012 end is 1676. And 2022, it is 1823. Just look at 1823 to 1676, approximately $160. That is almost 10%, less than 10% profit over a period of 10 years. Which means it is 1% on absolute, but compounded return is just 0.7% or CAGR, if you look at it, is 0.7 to 0.8% return only. Not even 1% as far as the international price is concerned. So that means that 5.5% in the rupee has come mainly because of the dollar rupee factor, not because of the gold. So gold per se internationally has not performed well over a period of 10 years. Okay, what it was 10 years back, it has just grown by less than 10% over a period of 10 years, right? So it brings us to a lot of questioning there, and whether at some stage that we can see a sharp rally and all, but you must bear in mind that gold generally moves due to so many factors. One important factor is the interest rate. So during interest rate hiking period, gold doesn't move well. So we need to get into a lower interest rate scenario for gold to do well. So it is very important that you need to really time the gold investment with regard to with taking into account certain fundamental factors. Most important thing is a US dollar interest rate. Now in this case, it has very clearly shown that 10 years return in gold. So everybody in the household will say that okay, gold goes up, okay. But nobody talks about Nifty going up, Nifty going up. So I'm not taking sides that no, you should buy Nifty or gold. I'm only highlighting the results. Now, if you look at the gold performance which we just highlighted, just look at it. On a 3 years, 5 years and 10 year basis, there's nothing that you can say that Nifty has performed badly. In a 2 year period, in fact, Nifty has performed even better. Only in this particular year, the gold has relatively done 8%. That is because of dollar rupee. Again, this factor has also come mainly because of dollar rupee. If you look at the entire period of 3 years, 5 years, 1 year, the major contribution of the gold rupee factor has come because of the dollar rupee. It's just come because of the dollar rupee. So gold internationally has not performed to the extent that probably the Nifty has performed. So okay, even if you take the dollar rupee, this 3 years, 5 years factor, if you leave it on a longer term, we have not got a great return as far as gold is concerned, but whereas we have got a very good return here. But this all can change. Now I'm comparing between 2012 to 2022. Probably a 2009 to 2019 scenario may be different. So we need to see it on a rolling basis. But in this 10-year period of 2012 to 2022, dollar international price, if you see, the movement has been quite, it went up, came. So unless we invested somewhere here, Okay. So if when we look at the performance of gold over a period of years, now even at from the lowest levels, approximately lowest level of 1300 levels, the last 5 years return is only 14%. Normally, when it bounces from the low, the return on this 5 years period should have been much higher, but it is not. So that means, and also a very large extent that is also contributed with dollar rupee. So international gold prices are not a great bullish asset over a period of last 10 years. The performance has really been highlighted because of the movement of the dollar rupee. Now, having said that, probably we have to suppose if you are doing only in gold, investment in gold bars or something which is nice idle, you will have only this particular return. But if you put it in the gold bonds, the government of India gives a 2.5% return, that is 2.5% interest rate. So that means you have to add another 2.5%, which makes it attractive now. So 1 year return is around 10.5. 4 year return you would have got something like, because this is not compounded every year they give it, but if you put that money you will get a little. So I'm not adding all those things. 16.5, here you get 16.75, you're getting 14.5%, and here you're getting 8%. So what happens is, because of this, we are now getting a slightly better return right now. So except this particular period of say 10 years probably, which probably we are slightly we may equalize it after some time. So it looks as if the gold investment over a period of, in a 3 year period, in a 5 year period, in a 1 year period, has turned out to be better than Nifty. In a case of 2 years, it has fared badly, and in the case of 10 years, also it has been. But overall, 8% you are getting a return which is almost better than the FD. Anticipating at some stage you will get a higher return of more than 8%, you can invest. So it's just an investable thing in gold bond rather than. So when you invest in gold, please consider two important aspects. One is that whether you should invest in gold or gold bond where you get a return of 2.5%, and you put it over a period of say 5 years or 8 years or whatever period it is. One. And second thing is, do this after a bigger correction. What is the bigger correction? One is that we have seen gold coming down from 2000 to 1620. This is a 25% of correction. So from 2030 it came down to 1620 or so. So that means you got some sort of a 20-25% fall. Normally it may not go much below that. So right now we have seen it breaking below that 20% mark, which is the approximately a 16 and 1620, 1610 or 1620 is. So it is just holding other. So 20% correction is where probably you can first look for gold buying. If that happens in international gold price, you get a 20% correction from the top, and then you invest, then you get a return. So now the prices are something like 10-12% down from the top. So in case if it starts going back to the $1,600, then yes, the gold becomes a good investable place for a period of 3 years, 5 years, and 10 years. So that we get a 2.5% return. Plus, even if there's a 10-year period, if it goes some sort of a return, you will end up with more than 11-12%. That is one point. Second thing is, those assets where the returns are not great, it could be even Nifty, but it could be also in gold. While doing the investment, you should also look at the whether you need to trade a little bit after you get into your investment cycle, but follow that with some sort of a trading approach. But only thing is that you have to have the taxation point in mind, because less than 1 year, because Nifty moves so much, and you sell, then you buy in the same year, and then next year only you will be able to sell. So you will be prone to higher taxation aspects as far as capital gains is concerned compared to long-term capital gains. So whether you have to weigh down between a 20%, a 10%, or a 30% in the case of derivatives. So you have to look at all those factors and take a call on the potential profit and the investment that you have done there. So you need to look at trading also as a tool in case of investment. So if you are passive, then okay, over a period of 3 years and 5 years, no, you definitely get a good benefit with a advantage in taxation purposes also. Now, so gold, uh, we are given the performances, and in no way it is outbeating Nifty in any very substantial manner. So you can also look at both Nifty and gold, but gold you invest after some bigger correction. Nifty also after you do from after a bigger correction, you definitely get a better return compared to investing at some higher level. So right now, let us say you are going to invest on a fall, which is 16,500 to 16,600, which will be definitely 10 to 15% down from the top. Then the return that you will get over a period of time definitely will be much higher, because you get that 10% plus there will be a growth from that place also. So you will have a much better factor of at least under 2-3% per annum over a period of time. So trading position along with investment be considered in gold, and look at gold bond. Okay, of course this will have a lock-in period, so each investor has to decide about whether that sort of a lock-in period is acceptable to them or not. Now let us look at silver as an asset. Now if you look at the performance of silver over a period of 1 year, 1 year, is given 12%. 2 year, in fact, the fall is minus 13%. That is, there is an absolute return is minus. So that is where there is a difference between gold and silver. Now the rupee factor is not able to compensate in silver. That shows the volatility in silver compared to gold. So it has the capability to the potential to drag you down over a period of 2 years, a negative investment, negative performance. 3 years in silver, a CAGR is 10.75%. 3 years CAGR is 10.75%. 5 years is 9.7%. 5 years is 9.7, and 10-year return, in fact it is I think that in the 10-year performance is generally even a negative performance. It is even a negative performance for a period of 10 years. That is from 2012. If we compare 2012, this one, it has given slightly a negative return in as far as silver is concerned. So this shows that clearly that a longer term, if the commodity price, if the commodity is going to go down, it is not an investable commodity. If you see, where have we got any good returns when even compared to gold or Nifty, except in this 1 year where probably it has given a return which is better than gold and Nifty. 2 years, 3 years, 5 years, 10 years, everywhere it is bad. So very clearly that shows that those who are looking at silver as an investment option probably have to look at only from the trading point of view. Time yourself properly to get an investment in silver and get out without holding this. So this is completely a commodity which cannot be held for a longer period of time, unlike Nifty and gold. Nifty and gold, definitely we have seen that there is a consistent performance. Average performance is consistent, which means it becomes an investable asset. This is not at all invest. So that is how you have to choose between whether you should trade a commodity or whether you should hold the thing. Nifty and gold are investable commodities, okay, or investable assets. Even if you don't do anything, I think by default it will give you things. So any multi-cap, any large cap funds which are approximately similar to the Nifty ETF will also do well. But what I'm trying to say is any broad-based Nifty thing will do well. But whereas if you see yesterday, I think last time we have shown even the Bank Nifty, and even Bank Nifty over a period of 1 to 5 years has done well. Again, you have to look at the broad-based one, okay, broad-based index. So if you look at auto, if you look at probably sectoral indices, there can be some negatives also coming over a period of time. For a period of time, it might not have performed well. But generally the broad-based one, then the performance generally over a period of 3 years and 1 year can be negative sometimes. In Nifty, even 18 out of 22 times we have said that it is positive. Okay, 18 out of 22 years on a close by closes, it is positive. So Nifty and gold are looking to be a good investable assets, and silver is basically a trading asset. You should time it and look at entry and exit carefully. So silver very clearly is an underperformer over a period of time, and hence is to be discarded. Now, interestingly, we will also look at it's not for investment, but to understand about crude, whether because every time we see the petrol prices going up, and they are saying that every time it's going up, no, it is biting, all those things. Okay, but generally we have seen the prices going up. So let us look at even the fuel price in the last 12 years, in 2012 to 22. In state to state it could be different. It was something like 65 rupees in April 2012. April 2022 it's approximately 102 to 105. So the 65 to 105, this over a period of 10 years. This thing, if you look at the CAGR, it is only 5.5%. Right? Sorry, in a 10-year period, in a 10-year basis, crude has gone by 13%. We have seen, sorry. Okay, crude now 65 to 105 is 40 rupees. 40 rupees is something like a 60% or 65%, right? So it has given something like a 5.5% return. So the year also, if you look at a longer period of time, because if you look at this, what is it? It is 40 rupees, right? 40 rupees. This is 40 rupees on 65. Let me say 40 divided by 65, so 61, 61.5%. So on an absolute basis, it has gone by 61.5%, right? From 65 to 105, on absolute basis, it is 61.5%. But over a period of 10 years, so this has not given a great return. When you look at the period of 10 years, over a 10 year, just look like a stock going only from 65 to 105 over a period of 10 years, giving a return of 61.5% overall on a 10-year basis, definitely means you are getting something only 5% or so. The CAGR is only for 5% or so. So this shows very clearly here again, the crude prices have been is definitely below the long-term inflation in India. Right now the inflation is about 6.5%, 7%. Sometimes it used to be 4%. So the long-term inflation curve in India is approximately 6, assuming it is around 6% also. So here the CAGR of crude price in the rupee terms is only in the last 10 years. 10 years back it was 65. Now it is 105. So if you look at that like a stock between 65 to 105, the compounded annual return or the compounded return growth in price, is around 5.5% or so. But in the pace of let us say in a shorter period of time, probably where it has bitten is this place. That is the 2 years. 2 years, if you look at it, 1 year also compared to 2021, 2022, it is only around 6.5% rise compared to 2021. 2022 price is around 6.5%. It is the 2-year category where we have got a 29% annual CAGR. That is, it has grown at 29% compounded. It has grown at 29% compounded, and in the 3-year factor, it's around 9%. So in 3-year period also, it is acceptable. And then we have seen in the 10-year and all is around this 5.5%. So basically, where it has really mattered is only in this particular period. So this is not something which is a very, but of course, over a period of time, crude prices have generally trended to be on the slightly on the upside. But we must remember that in international prices, crude can also be negative over a period of 3 years and 5 years. That we have seen sometimes also. So crude as such is something which fluctuates. It cannot grow like an Nifty. So what I'm trying to say is, in the case of commodities, particularly in the case of crude, it cannot. In the case of equity markets, if you look at it, generally, it is linear. It is linear. Depending on the, there will be some corrections, but the overall map will be only because we have seen Nifty so many 25 years back it was some low level. In 2008-9 it was around 2,200, and now it went up to 18k plus, right? So in between there was some fall, 12k, then it came to 7.5. Then so we have seen generally it moves up, that means it is a factor of the earnings. Clearly, if there is no big recession, so that means it is earnings growth, EPS, EBITDA growth, which in the case of Indian companies generally now are in an upswing, with the factors anything between 10 to 15% over a period of time. So over a 10-year period it must have grown 10-11%. In the recent period of 5 years also it must have grown at 15-16% also per annum. So the EPS and EBITDA will gives the confidence in Nifty. That is where the confidence comes as far as Nifty is concerned. In the case of gold, it is primarily the confidence is coming from dollar rupee factor, which over a period of time depreciates by 3.5 to 4% over a longer period. So this gives the return. Plus you have got a 2.5% in the bond. So this I feel this is a take of 6.5%. Then if you get the international price moved by 3% to 4%, it's okay. You get the 10.5 to 11%. So that is where the gold success also is there. But that is because the gold volatility is not that much compared to crude or silver. Because of the volatility in the gold and in silver and crude prices, dollar rupee does not play that important part in guiding the rupee factor, in guiding the rupee prices of those metals and commodity. Here in this case, gold, the volatility is a little more subdued. There are up and down movements, but it's not that it moves from $1,000 to $2,000, $3,000 in a very short period of time. Unlike crude, which has the capability to double within 6 months. So that sort of factor is not here in there. So very clearly, two things are borne out by these performances. Crude and silver are trading assets. Gold and Nifty are basically investable assets, where probably even by default, if somebody owes over a period of time, they are bound to get a return which could be varying over a period of time. So what we should attempt to do is that we should look at, there are two ways of looking at the investment as far as the gold and Nifty are concerned. One is the buying on a trend, second is buying on a counter trend. Now let us say right now the markets are dropping. Now it is dropping down to 18,000. From 18,800 it has come to 17,800. So this is 1,000 or 5.5% drop approximately. 1,000 points is approximately a 5.5% drop. Generally speaking, even this particular period when the prices went down in India, it did not drop by more than 17%, right? Internationally the prices are down more, but in India the prices dropped only by 17%. So we will presume that this 17% the fall that has taken place is over now, because we got a higher up move towards 18,800. So now we presume that from now onwards whatever happens is going to be only a correction. So in that particular case, the investment as far as Nifty is also concerned is from 15th, assuming that 15,200 which came and 18,800 in between moves will consider as a noise. So this 3,600 rupees, you just look at some Fibonacci correction. Okay, so 3,600 points we have into 0.386, 1,400 points, which means 17,400. So next thing is 17,400. Then probably 50% retracement, 1,800 points is 17,000. Then a 61.8% retracement of 3,600 is 1,400, so 16,600. So now when I say that where are the places that you should invest, these are the places: 17,400, 17 and 16,600. You invest. Now 16,600, we have already said that this is a good place because you get a PE which is around 20, and estimated EPS is going to be 830 now for this year, which is in the next 3-4 months. So if you get this, then 16,000. Normally the PE this has not gone below 20. So there's a great hope that this time the valuation for this year could bottom out exactly at 16,600 and will not go down further. But we never know that it will come up to 16,600. So what we should do is that Nifty ETF we should buy at 17,400, 16,600, and we have already said that by next year, if it goes to 20,000, then 17,400, this will give you 2,600 points, which means we would have got something like 2,600 divided by 17,400. it got a 15% return over a period of 1 year, 1.5 years. So probably, we might have get something like, if it is going to happen, if you buy now in February or March, if it comes down in February like this, then next February and March we should be comfortably cruising towards the 20,000 mark, which should get us something closer to 15% per annum as far as Nifty is concerned. So those who are looking for that particular return can look at Nifty at these levels of correction: 17,400, 17,000 and 16,600 levels, right? So this is what we have to say today, that we have given a comparison of performances between different asset markets, and basically to give you the confidence where you should invest. Now, as far as trading is concerned, we need to adopt a slightly different technique, which we'll highlight in coming week. Basically, suppose if you have invested earlier, okay, that probably could have been something like the same correction factors which we discussed about. So it went up, it was 18,600 levels, so it came down to 15,200. Let us say you invested in various places in this case, and so probably somewhere in the middle you should have been 16,500, or even it could have been at 17,000 levels, right? So maybe it was 17,000. Now it went up to 18,800 and started to drop. And once you know that there are certain places, important places which are cut, then in that case we should be coming out. So the one factor that happened is 18,800 it went. Once it started dropping below 18,400, which was the previous peak on a close basis, once it started to drop below the 18,400 mark, then probably whatever that we did on an average of 17,000, we should have got out at 18,400 and wait. So, but while doing this trading, once you take the profit, in that case, when it drops down, then in that case you should not wait for again the trend to pick up, because by the time you trend to pick up, you will end up buying at a slightly higher level in a bullish market. So what you should do is that we should once you have cleared yourself 18,400, we should look at different places for investment. One important place that we have looked is the 17,400. So if you get a chance 18,400, we should look at something like a 17,400 levels where you should go for an investment. Suppose if it doesn't come, then what we should do is that we should look at, if it cuts this 18,300, which is the recent 18,265, 18,300, if nothing happens to 17,400, it starts to go above this 18,300, we need to take this 18,300 and go ahead with our trade. So basically this type of an trading investment can boost your overall return. Now if you are passive, I told you that 14-15%. Now what you should try to aim through your trading methodology, which we'll explain next week, is that another 2-3% whether you can get more. Another 2-3% at least. I'm not talking about a dynamic trader as far as intraday is concerned. That's a different cup of tea. I'm only talking about as an investor, taking profits at an important levels and then reinvesting it some. So a couple of times in a year, if you do that, then how is it that you can boost your total return? Okay, depending on probably, because some 1 or 2 times it will look as if you are trying to catch up whatever that you sold at a slightly higher level than where you sold. That can happen. But over a period of time, I think if you continue to do that, I'm very sure that you may get slightly a better return. Okay, so we will look at that point of from that point of view, what needs to be done. Okay, so if you have any questions right now, please ask. Thank you very much. So thanks for the participation today, and have a happy weekend. We will see again next week with a very important topic, both on Tuesday and as well as on next Friday. Thank you very much. Good night.